This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. What is the variable you look for to think, okay, these are great companies, they're cash rich, super safe in terms of their balance sheets, but actually now the valuation constraint is going to maybe start to weigh a little bit?
What's really, really important for me is the gap between tech and the rest. So I want to see a good place to go to. I want to see another area that takes this leadership. The other kind of really interesting way of thinking about it, what is kind of the most interest rate sensitive area? Okay, now it's the economy is slowing, we're having rate cuts. Who should benefit from it the most?
There's not much need for a Santa rally in stocks this year, but it looks like we're set up for one anyway. Q3 earnings season is now winding down. Most of the big tech names have reported. While some of their results were a bit mixed, the hurdle of expectations was actually pretty low, and it's hard to see too many points of weakness that might kick off a broad pullback in stocks. But to be honest, I am thoroughly bored of tech stocks. I'm glad they're in my pension and all that, but we know all the reasons why you should like them, and their performance so far has justified those reasons. I'm really bored of the soundbite you hear when people talk about them and their stretched valuations, which goes something along the lines of, gee, I can't really see what's going to get them to crack. Well, that's kind of the point of markets, isn't it? By definition, you can never know what unknown will really drive a change in trend. So this week, we start the discussion with Maria Bateman, our head of equity strategy, talking about what else to look at. And then, yes, we do spend a few minutes bowing at the altar of the Mag 7. Enjoy.
Hi, Tim.
Hey, how's it going?
Good. How are you?
You know how when you take off and then you basically have to do all the work that you would have done during the time you take off?
Yeah. No, it feels like 4 days a week. I mean, it's fantastic when you have long weekends, but then you feel like you're paying for it for the rest of the week.
Oh, totally. One day off is maybe worse than having a week off, but having a week off is also... Anyway, so we're going to do a podcast without talking about tech. And that's not true. We're going to get to tech. But there were some other things I wanted to ask you about it as far as a long-term outlook before we get to tech, because of course, I'm sure that's going to feature in any long-term outlook of any sensible investor.
Okay, let's see how many minutes we'll go without mentioning tech.
Okay, so perfect. So we are recording this at 3:08 on Thursday, the 30th of October. I will then read the time it takes us to where we finally get to tech. I want to obliquely get to that or start the conversation. Yeah, we had Matt Smith on the podcast a couple of weeks ago, and he's a value investor. And I wanted to actually get your thoughts. Not, don't say anything mean or anything, but what do you think about the quest for value and that side of the market when it is just quite obviously all being driven by the AI narrative?
Yeah, I don't know. I have this chart in my presentation. It used to be on page 28, and now it's progressively making its way to the front. And we actually put it on the front of our Equity Monthly last month, and I call it the scariest chart in my presentation. Yeah. It shows the performance of value stocks relative to index. I mean, the line goes top left to bottom right for about 20 years with a short interruption. But what's even scarier on that chart is that I put investor holdings, so from our custodial database, in value relative to growth. The chart starts in 2000. So it's kind of 25-year low. So investors in our data set, so large institutional investors, they kind of given up on value. I mean, that's terrifying. I mean, I understand why they've done it, and that's kind of backed by performance, but that's terrifying. It's basically telling us that investors, struggle to find value in value. Maybe there are more sophisticated ways. And I know Matt, he's very, very good value investor, and being in business for so long, I'm sure you can find ways of kind of doing it better and finding some value. But it is extremely difficult. And lots of investors are going, quote unquote, for easy way, and they're following momentum and following growth strategies, doing very well. Is that a bubble? Is that a huge concern? Probably, but it's really difficult to see when it kind of we get from there. Why would we buy expensive things, right, as a style, which seems to be what investors are doing? And I think it's a pursuit of something else, pursuit of better earnings growth, better fundamental, better margins. And if those tend to be expensive, so be it, because better fundamentals are scarce. To be honest, there are lots of nuance to the story. I mean, that kind of US-centric story, global story. I mean, in Europe, we had value doing a little bit better for actually quite a while with strong performance in financials. We had some value trades doing well in like Japan, so traditional value areas. But it's still quite narrowly driven. Okay, European financial done really well, but like traditional value sectors like, I don't know, staples and utilities haven't. So it's not like universally value, but there are some value somewhere. Yeah, you need to be very skilled value investor to find value there, but it's a lot easier not to. It's a lot easier just to go to, for momentum and quality.
That's what I was going to ask. I mean, is it required for you to be a stock picker? Like, you can't just buy a value index because you get all the garbage and the value trap lumped in with the things that actually might be good investments for those who are willing to do the bottom up work.
No, absolutely. That's definitely true. And I'm sure that's what that's kind of discussion you had with Matt, is that you can find value, but it's not easy. It's much easier to follow momentum. It's much easier to back yesterday's winners and just follow that. And that's been a great strategy for lots of people, it's been their entire career. And then people start questioning, why do we need to go to value? Why do we need to kind of uncover those kind of really difficult situations?
So we're at, okay, we've done about 4 minutes now. Now we're still gonna skirt the topic. What other than tech do you like? And it doesn't have to, I'm not asking about it in a value context, but for people who are maxed out on tech right now, and we'll talk a little bit, actually, there's some interesting things going on with the off benchmark exposures we track in country level equities, where it does seem as though there is a fullness of exposure that people are maybe starting to get a little bit worried about. So for those investors who think, right, I have to own this, momentum and growth are just indomitable forces. But what else can you throw in there as, I don't even want to think about it as a diversifying vehicle, but just something that maybe it has value or it's underloved, or it just has a good fundamental story that you really like that you could add to a portfolio alongside those exposures?
I mean, the way, Tim, you phrased it, I quite like. So it's really not kind of diversified, it's just something else. And it's really kind of marginal. So there are like few things we point out, like European small caps. That's an interesting story in a sense that, ECB has managed to cut interest rates. Domestically focused interest rate sensitive companies in Europe, they do quite well. So that's kind of one small thing. I mean, miners is kind of all the rage now with a kind of precious metal doing fantastically well. Institutional investors are still kind of underweight mining stocks, so there are maybe some opportunities there. China keeps coming up on institutional investors' radar, so they started the year with a big underweight in China. There are lots and lots of kind of structural reasons, but then Chinese authorities kind of pushing and supporting domestic stock market. I mean, we can debate whether it's kind of solving the long-term structural issue, but institutional investors have not participated in that rally. Now the closings are underweight, so there is kind of scope for those kind of technical trades to go on. So we're trying to kind of skirt on the margins a little bit.
Any kind of U.S. sector views that also look interesting to you? And I'm particularly thinking not just for the short run here. We have pretty frothy markets right now, and we've already had a small pullback in the last few weeks, which has since been completely shrugged off. But again, looking at large cap exposure, I'm just curious if there's anything in a U.S. market that is dominated by these huge tech companies that also looks interesting.
Healthcare stocks look really interesting, and they looked very, very interesting for quite a while. So it's the largest underweight position that investors have in US cross-sectionally. So we compare all the sectors. It's also close to the largest underweight position people had in healthcare stocks for good 20 years. So it's really, really, really unloved sector. And there are really logical, fundamental reasons why you might worry about healthcare. It used to be reasonably high margin sector, pre-COVID, I don't know, pre-COVID, same kind of pre-2000s, like margins were double digits and it was like kind of consistently growing. Since then, margins kind of halved. So yes, that's a big problem. We have huge regulatory issues, but it looks like things beginning to like stabilize and look a little bit better on the margin. Margin growth is kind of picking up, and in consensus forecast is going into double digit maybe next year and year after. So that's quite good support for kind of improving profitability. Regulatory issues, I mean, they're still there. We're going to talk about US administration policies that really disruptive for the sector, but it looks like we cleared some known unknowns. So, okay, things are not going to be fantastic for the sector, but we kind of know where we stand a little bit more. So there are more deals that companies are making, like Pfizer was like a good example when they made a deal with administration. So in exchange for certain investments, they can regulate prices, and we kind of know where we are. And I think that's really, really important for investors. So there is more certainty in the sector. So given this extreme low ownership and valuation obviously is very, very low in the sector, I think we potentially can kind of draw the floor given where we are. And investors coming back to the sector. I mean, in fact, it's a sector with the strongest investors buying like over last month, for example. So people begin to kind of look for alternatives. So I think, Tim, you're kind of right. So yes, people own tech. We know that. So what's next? And it's not like they're giving up on like the big trade, but they're trying to find other areas of exposure.
I mean, speaking to the US market, there's, of course, this ongoing debate about the health of the US economy. And I wanted to focus on consumer-oriented stocks as well. And the popular narrative, and there's enough, I think, data. Well, there's no data right now, given the government shutdown, but I think has been enough data to support the notion that there is this sort of bifurcation within the US consumer where the very wealthy who, we talked about this in previous podcasts, the top 10% asset owners are responsible now for 50% of consumption. And that's a big change from the past where it was the more lower income consumers you really had to worry about in terms of the health of the US economy. That is less the case now. And I guess the question I'm asking is your take on the economy and whether that makes you more inclined to go towards discretionary, particularly discretionary with exposure to the US consumer, or to staples, and whether that more defensively oriented sector is actually attractive in an environment where growth is slowing. Maybe it's not slowing for the highest end consumers, but the overall median consumer, it is slowing, and that staples might actually look appealing.
Yeah, that's a really good question. And I mean, during COVID, we all talked about this K-shaped recovery, K-shaped economy. I mean, I quite like the kind of the terms, yes, but economy. So yes, overall US economy is doing quite well, but it's driven by a very narrow set of agents. Tim, you mentioned the higher income consumer, like in the stock market, is going gangbusters and corporate profits are fine, but yes, but it's all about like those like mega caps that do really well. So I think in terms of a consumer, I think you're exactly right. It's all about higher income consumer. Lower income consumer, I mean, challenging. I mean, you're probably the first person to point to kind of work we do with Indeed and some charts on kind of labor market. Yeah, it's looking soft and it's hurting lower income consumer, absolutely. People who have less and less savings. I would go as far as to argue that middle income consumer is struggling as well. I think it feels like it's incredibly difficult for middle income people to afford property. Almost like 70% of disposable income goes into real estate and kind of paying either rent or buying houses, and affordability is horrible. So middle income consumers, they're kind of squeezed out and their spending could have gone somewhere else, are kind of disappearing in this kind of property market. So that makes me very much focused in our investment selection on margins. It's clear that like slowing consumer means margin squeeze. So which margins can sustain, or which companies can kind of sustain profitability given where the margins are. And in that sense, consumer staples are in a really particularly difficult situation because that's the sector with the lowest margins historically. It's kind of big volume game, but margins are tiny. So food retailers are like 4 or 5% margins. And if you have this inability to pass higher costs, be that from tariffs or wages or commodity prices, property prices, taxes, what's not, if you have higher costs, can you pass it to consumer? It's really difficult. So in that sense, discretionary companies have somewhat higher margins on average. I mean, probably 50% higher. So they probably in a better position to withstand those challenges. And again, they discretionary often sell to kind of more affluent consumer who can continue the demand there.
Will margins matter, though, if you do get a more pronounced slowdown in the US economy and you have those high income consumers all of a sudden having to shop at, I don't know, Aldi or Lidl? They probably don't have that in the US. That's more of a UK thing.
Target and
European.
Costco.
Target, there we go. Yeah.
Yeah,
I mean,
you've been living here way too long.
I've forgotten all the shops that I would go to as a kid. But I mean, that's classically why staples tend to do well as a defensive sector in a slowdown, is because you get higher income consumers who all of a sudden have to say, oh, no more Louis Vuitton for me. It is Kmart or whoever, Target. Does that offer any appeal, or is it just simply that margins in the sector in staples are just too thin for that to even make them attractive, and the overall economic picture just makes it not even a good relative view?
I mean, right now, what we see in our custodial database, institutional investor holdings by sector. So what they're correlated most with is margins. So it's almost like 80% correlation. So investors really right now want to be in sectors where they overweight are only in the sectors with higher than average margins, and they underweight every single sector where margins are low and falling. So right now, that's really kind of differentiating factor in terms of investor positioning. And I guess it goes back to this idea that we just discussed. Yes, but economy. Because there are some companies, some sectors, some areas of the market that are able to maintain margins, and they're gearing towards parts of the economy that's still doing well. I mean, it's not like that everything is slowing down in the US, but there are some significant chunks of the economy that are not. And that's where the margin pressure is. And that's what investors really try to avoid.
Okay, well, we're going to gradually make our way to the big topic, but I'll start very overarching with thinking about the U.S. and the momentum of U.S. stocks. But actually, one of the things that surprised me this week, I was updating the presentation for some travel I got next week, is the overweight in aggregate to U.S. stocks has actually gone down this year. And Q1, there was some pretty good reasons for that. You had a little bit of a hiccup in the tech sector with DeepSeek. You had some policy uncertainty that then came in towards the end of the first quarter, beginning of the second quarter. You had European fiscal expansion that really drove a lot of rotation out of US into Europe, at least temporarily. But I'm surprised to see that the overweight US exposure is still far and away the biggest country level exposure in our indicators, but it is not what it once was. And I'm curious as to why or how you can kind of balance the notion of growth seeking, momentum seeking with actually smaller off benchmark exposure to the market that gives you those factors in spades.
I mean, it's not really like what we've seen in Q1, where we had rotation out of US to the rest of the world, right? We saw like in Q1, we saw quite a big move towards European stocks, we was buying of Asian stocks. It's not really what's happening now. I think now it feels like investors are just getting closer to benchmark. And I mean, maybe sensible. I think I counted 36 all-time highs made by, was it S&P or maybe MSCI World? But anyhow, so stocks going higher and higher, kind of understandable with valuations where they are. It's understandable that investors are kind of getting closer to their benchmarks. So I think that's to a large degree what's happening. So it's not like people get out of the US and go somewhere else. I mean, US is still pretty much the only large overweight position that investors have. It's still very much large caps and growth stocks and tech. So that's where they have. So yeah, I think the size of the position has gone a little bit more, I don't know, I like to use the word normal, less extreme. Let's put it that way. As we kind of talked very early on, is that like it's not like there are other huge opportunities where investors moving into, and our discussion about healthcare is kind of, okay, that was real extreme positions, people trying to get it a little bit more like right size.
Okay. Well, We've now done 22 minutes, so I think it's time we've had some big earnings announcements this week in the tech sector and the communication services sector as well. What do you make of what we've seen so far? I mean, we know expectations were pretty manageable in terms of these companies beating them, but there have been some disappointments, and I'm just wondering what that changes in your thinking for the tech sector, communication services sector, especially for the next year or so, where expectations, I think, over the long run for these companies are still pretty punchy.
Yep. Yeah. No, that's obviously very, very topical right now with big tech reporting. I mean, I think there are kind of 2 points I want to make. I mean, first point is pretty much every tech company that they all talk about that demand for AI still exceeds supply. And I think that's really, really important point is that companies investing, I mean, this huge CapEx spend that they're doing is not going into in the hope of future kind of demand. There is still a very tangible future, like demand for whatever they're building, for the compute they're building, it's there. So that's encouraging. And we hear from quite a lot of companies that they already kind of make money on that. And I think Microsoft was a good case in point. Alphabet was a good case in point, already kind of making money on whatever they build. Not everyone, and lots of companies obviously investing really, really heavily. They also have a ton of cash to invest. Actually, Mr. Risk, our colleague, asked me to kind of help him building the chart in terms of what proportion of free cash flow they're investing into CapEx. And okay, last couple of years ago, it was less than half. Now it's about 3/4 of the free cash flow they generated going into CapEx. It's generous, it's enormous, but in general, they have money to do it. But the other point we kept making for quite a while is tech is still kind of the Stina trade. There is no alternative. So the chart I have been updating in my presentation is looking at corporate margins, and tech margins are double of what we see in the rest of the market. What we've seen this year, tech margins has increased. That's something that is really, really difficult to achieve for other companies. And that's, to my mind, is why investors still kind of in this difficult position when they have to pay a high premium for those superior earnings. Forever we talk about broadening, diversifying, going to other sectors. Yes, that's all well and fine, but you need to go into the sector and area where you have good earnings growth. And that's really difficult, especially given like the conversation we just had about kind of margin compression and some consumer really struggling. So that kind of all ties together is that, okay, tech makes enormous amounts of money. They choose to spend it on CapEx. Sometimes investors like it, sometimes they not. But they're the ones who have this enormous amounts of money and enormous cash flow generation ability. Other companies don't have that.
Yeah, a couple of questions on that actually. So the expectation for next year, I was looking, is for the companies in the S&P 500 at least, is for further margin expansion as the expectation for 26. When that changes to either be stable margins or maybe even smaller margins, is that the signal you look for that maybe the enthusiasm has peaked, or is it something else? Is it just simply earnings growth starting to peak? What is the variable you look for to think, okay, these are great companies, they're cash rich, super safe in terms of their balance sheets, but actually now the valuation constraint is going to maybe start to weigh a little bit?
Okay, I'm going to blow my own trumpet and talk about chart of the week that I just submitted for the team. So the chart is that looking at margin expectation for tech versus everyone else. So, and that gap is growing. We know that tech margins have to come down. The earnings growth has to come down because, I don't know, take NVIDIA, it's like 4 times bigger company than it was a few years ago. So you can't grow exponentially forever. So, okay, the gravity is there. So they should kind of slow their earnings growth. It's probably not necessarily a sign of, okay, end of tech. But what's really, really important for me is the gap between tech and the rest. So I want to see a good place to go to. I want to see another areas that kind of take this leadership. The other kind of really interesting way of thinking about it, what is kind of the most interest rate sensitive area? Okay, now it's say economy is slowing, we're having rate cuts. Who should benefit from it the most? And I mean, small caps come up in pretty much in every conversation I have with clients is that, okay, when is the time to buy small caps? So the chart I actually have pinned on my Bloomberg terminal is performance and kind of fundamentals for Russell versus Max 7. That's like really important. It's like when we get to see this kind of earnings growth really improving, when we see kind of the stimulus that come into the economy really benefiting those small companies that underlying economic sensitivity. So that's a really good kind of bellwether for me to see. And for now, really going the wrong direction is at the start of the year, we had some hope for small cap companies. And I mean, Trump trade, if you remember, that was animal spirits, economic growth, everybody benefiting. And since then, earnings expectation for small caps just gone one way down, margin expectation getting smaller and smaller. So it's less about something specific happening in tech sector. It's more about kind of the new home for the money.
Last question on this sector specifically. There's this circularity concern that has made the rounds, and for good reason, right? It's NVIDIA and OpenAI basically mutually investing in each other, and there's a lot of reasons to think this isn't a big deal, and we've talked about some of them, just given the strength of a lot of these companies. But you've also mentioned the investment point and how much capex is too much capex, and is it chasing potentially suboptimal returns? Can you address this kind of circularity question, though?
I think it's something that worth keeping an eye on. It's not a huge concern, mainly because those companies are those kind of tech giants. They have cash to invest into this new technology. Yes, it is unknown. It sounds quite revolutionary. It sounds really exciting. Ability to monetize, I mean, big question marks. I mean, maybe it's more prudent to stay with kind of infrastructure providers, semiconductor companies, your cloud computing companies that provide services for AI development. So maybe that's an angle. But in general, as long as we see demand for compute being higher than supply, for tech mega caps still generates enormous amount of cash in maybe some other businesses, maybe broadening to the kind of customer base. For now, that's kind of something on the back of our minds. It's not like the huge immediate risk to start worrying about.
Actually, just as you were speaking, I was looking at the year-to-date returns, and the U.S. has underperformed this year. We mentioned earlier in the year there was the rotation, the U.S. versus Europe, and the U.S. was actually lagging by quite a lot. It, of course, has caught up, but it's only just caught up. Japan has outperformed the U.S. China has outperformed the U.S. Certain European markets actually have outperformed the U.S., and I'm thinking here of Italy, of Spain. For next year, is it the U.S.'s turn to take back the mantle and to outperform again?
Well, U.S. has been my favorite trade for year-ahead trade for the last 3 years. I think the story is still there. And okay, I mean, U.S. had obviously setback in Q1 with new policies, massively outperformed since kind of post-Liberation Day when things settled down. Again, I'm big fan of this tech AI story. Rest of the US, it's marginally better than European stocks or rest of the world, but tech mega cap is getting bigger and bigger and dragging the index together with it. So yes, there's this kind of yes but economy. I think we're still not diversifying, not broadening. We're sticking with those winners until we see either overall recession and everything collapses and we have a huge rate cuts. Then after that, we buy new value stocks, or we bump along and better parts of the market, or stronger part of the market, stronger fundamentals continue to lead. That's kind of a scenario. I think I'm very much more in kind of bump along camp, other than kind of recession and kind of big unwind, big collapse, and kind of big clear out with big decline in interest rates. I feel like I'm going to stay with US relative to the rest of the world, right?
Relative and absolute, of course.
Oh, absolute, for sure. Yeah. I'm equity analyst, always have absolute.
Fantastic. Well, Maria, it's been lovely to get your thoughts, and especially at such a pivotal time in the market where people are starting to think about some of these risks, but also are looking ahead. So it's great to get the notion that you're not going to change anything.
Oh, fantastic. Job done.
Excellent. We'll speak to you soon.
Fantastic. Have a good day.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time.